G'day and welcome to this week's video. This week, or over the last couple of weeks, I've actually caught up with quite a number of people from some of the larger city centres that have come to us for an initial appointment based on watching our YouTube videos and other marketing that we do, which is great. So thank you very much for those people that have reached out. It's great to see people from different scenarios. And one thing that I've seen in common is there is a substantial amount of investment property within their portfolios, and with that comes a huge amount of debt with that. So there's a number of issues that really highlight to me with this strategy. And a lot of these properties, for some of these clients, have done very well, and some of them are more recent purchases, and from a capital gains point of view hasn't done terribly much. But there's probably three key points that I wanted to cover off in this short video, and one was obviously there's a lack of diversification in some very big assets, very lumpy assets. So it's a big bet on property continuing to do well. And as I said, a lot of these properties have done well, and this is not a video or comment about the property market. It's done particularly well over the last 40 years for everyone that's owned property. I do have doubts about the coming years ahead of us, given interest rates and historically high debt levels. But yeah, there is a lack of diversification. The second point was, this is all debt driven. There's huge amounts of debt there. Debt equals risk, as always. And the third point is probably the key point to this video, was that the cash flow draw, particularly with increasing interest rates, have had on these loans. It means that cash flow is tighter. Quite often these properties are not positively geared, they're negatively geared. So it means it's costing you've got to find money to prop up the cost of ownership, including the interest you pay, the rates, the mates, and so on. Having this extra cash flow draw on your money means you're often missing out on other substantial benefits or wealth accumulation strategies, like simply salary sacrifice into superannuation. So because your cash flow is needed for these other assets, you're missing out on one of the easiest wins that any financial advisor or any investor can take advantage of, and that is, instead of paying tax at your marginal tax rate, which can be as high as 47% with Medicare, you can pay as little as 15%. So a person on an income between $45,000 and $120,000 pays 34.5 cents on the dollar, including Medicare and tax, compared to 15. That is nearly a 20% return. And because a lot of these people have these high big debts which draw a lot of cash because the investment itself is not paying its way, that money's got to come from somewhere, which means we don't get to do the salary sacrifice strategy, which is much lower risk, but a huge kicker in terms of tax saving and future wealth accumulation. Provide some comments and feedback in the comments section if you like, and I suppose your experience, and has this strategy meant that you haven't been able to salary sacrifice as much, or have you put your property that you've purchased as an investment in a self-managed super fund, a common strategy. Thanks for listening. We'll catch you next week. See ya.